Hello and welcome to the MIT Center for Real Estate podcast. My name is Sam Jakshtis, a current student in the program, and today I'm excited to be joined by Greg Dewerpe. Greg is a founder and managing partner of NOAH, Europe's largest venture capital firm dedicated to the built environment. NOAH focuses on investing in pioneering founders and breakthrough technologies within the built world, aiming to transform the industry to be more sustainable and efficient. Gregory also serves on the board of several innovative companies, contributing his expertise to drive growth and innovation. Greg, thank you for joining us.
Thanks for having me. It's a pleasure to be here.
So I'd love to know a little more of your background and what led you to found NOAH, what gaps you saw, maybe a little bit about your early career and what led you to be Europe's largest VC for the built world.
Sure. I would say it's an unconventional journey, and it's going to sound much simpler than it actually was. As you know, life is full of twists and turns. I started my career, so maybe a step back. I'm originally from Switzerland, where I grew up in a small village next to a town called Lausanne, in the French-speaking part of Switzerland, and then left to London to do my master's and started my first job at what seemed to be a very cool job at the time, which was being an investment banker. That just should tell you how long ago it was, because it's definitely not cool anymore. And what was meant to be a year to figure out what I was going to do next turned out to be almost 10 years, going through the great financial crisis and kind of navigating New World Order back in the day. I always knew I was not meant to stay a banker for the rest of my life. I always thought this was very self-centered, a lot of ego in this industry, and not necessarily a lot of purpose. And I just needed to find, the way for me to go on to do better and greater things. But obviously, there's a financial reality. You need to pay the bills, and you need to kind of build yourself. When I turned 30, I decided that this was my last chance to escape what seemed like a comfortable golden cage, because I was still single, no wife, no kids, so I could afford myself to take irrational, or what seemed like an irrational decision back in the day, to just go and figure it out without knowing what I was going to do next. I only knew what I didn't want to do, which was being an investment banker for the rest of my life. And that was enough for me to make the jump. I probably had a year and a half to 2 years of runway, cash flow runway from my savings to go and figure it out. And it was one of the most difficult times of my adult life, having, to figure it out, going in the real world after having been kind of relatively protected, being within a big, large international bank. And, I always thought I'm going to figure what I want to do next. And what I wanted to do next was something that could allow me to get closer to this idea of being financially free, so that I could really do what I love for the rest of my life. And I started a real estate advisory practice. So I didn't have any credentials to raise any money back in the day. So I had to start by advising people and consulting people. And it took me a couple of years to get my first deal. So it was a long drawn journey to get there, where a lot of doubts and self-doubt. And I think I came very close on multiple occasions to go back to being a banker for the rest of my life. But I was fortunate to have a lovely wife who kept me going. And what then followed is an incredible few years where I did advisory and then started raising deal by deal capital to go and acquire assets, then developed a discretionary strategy to go and take stakes in publicly listed companies. So more like a fund mandate. Across those three, let's say, verticals, I've deployed close to $5 billion of capital. So this was quite transformational for me personally, for my reputation in the market, for my network, for my access, and for my understanding of this industry by becoming an insider. And so in my late 30s, I decided that, I had ticked the box of financial freedom. And as much as I loved real estate, I thought that there was maybe better things that I could be doing. I think I had a privileged seat in the industry to understand its shortcomings when it came to technology and innovation, at least the approach to technology innovation. But also there was already looming in the background in Europe what is today kind of a very tough regulatory environment for non-climate compliant assets in Europe. And so I decided to basically take the fruits of 20 years of a working career and leverage all that I learned, all the network, all the connection to go and raise my first fund in venture, which was not necessarily easy as a complete outsider to venture capital and someone who didn't have the network in venture capital or any sort of credibility. What I had was a lot of investors that had been working with me in the real estate that trusted me, had been successfully in business with me, and that could actually understand what I was talking about because they saw also firsthand the opportunities and the challenges surrounding technology in the industry. So after a few months of trying to decide whether I was going to go, I obviously asked opinions around, and everyone told me I was crazy, that I could never even raise 5 million if I wanted because, hey, I'm not an insider, I have no experience, no credentials. And so I decided that's good. That's a great challenge to take on. Let's go and do it. I think I had the passion to really drive this because I thought I can really use everything I've done and then leverage technology and capital to improve this massive industry. And I think that's a very exciting mission to be on. So raised the first fund, announced the first fund in February 2020 in the middle of the early innings of COVID, and announced a 250 million euro fund, which I think caught a lot of people by surprise because I didn't even have a website or anything. So I think there was initially a little bit of skepticism around, who's this person and what is he trying to do and what is he doing. And fast forward to today, we have a team of, slightly more than 10 people based out of London. We're investing out of our second fund. We're in and around closing in on about $500 million of AUM. And I would say that the rest is history, but I would say it's such a long feedback loop industry that as successful as we think we are, or as on the right track as we think we are, nothing should be taken for granted because early stage technology investing is very difficult. You never know until you know, and until you've sold a business and returned capital, anything can happen any day, any time of the day. So we're grateful, we're excited, and I think it's always good to be able to create and set up a business despite all the negativity and the naysayers and the doubters. I think it's an extra fuel and motivation, at least for me.
Amazing. And one of Noah's core missions is investing in a better built world. And I'm wondering if you could go a little deeper, and what does that specifically entail, and how do you weight some of the factors of what a better built world is? It sustainability, efficiency, affordability, resilience? What means a better built world in the terms of Noah?
Sure. I think we've thought a lot about how to frame this. I think over the last few years, where particularly, I think a lot of the fundraising was easier for pure play impact funds, or that were just focusing on impact. We always have had a different view, which is, first of all, it's the largest industry in the world. It's a $380 trillion industry. But more importantly, it's the least, or one of the least digitized industry in the world. And it's also the most polluting one. So there's a lot to unpack. And our view was always, look, if you only focus on pure impact and climate, you're going to struggle to actually deliver real impact, because this is an industry that's suffering from being tremendously antiquated and analog. And unless we invest in digitalization, automation, data, well, none of the climate endeavors are going to be actually able to deliver serious impact. So our view is positive transformation is all of the above. Is, of course, decarbonization, of course, it's resource efficiency. It's also resiliency against the change of climate. And it's also digitalization, more efficiency, and more automation. I think they all go together. And our view was always trying to sell a product in the name of sustainability or the environment or climate is actually the wrong thing to do, because these are terms that are very triggering and subject to political volatility. And I think our view was always, yes, we want to deliver, positive transformation, decarb, and all those things, but let's make sure that we don't lose sight of the type of businesses that we want to back. And those businesses need to deliver financial ROI, operational ROI, in addition to deliver decarb or climate resiliency. Therefore, you can then sell them in the name of, hey, this is purely a financial decision. Doesn't matter if you're believing climate change, doesn't matter if you care about climate, doesn't matter if you're Republican, Democrat, or independent. Money talks. And if there's a financial ROI, and it so happens that the cherry on the cake is that you become more climate compliant, then great. Doesn't matter what the motives are for us. What matters are the results. And so I think it's kind of how we frame this positive transformation. And our belief is really that our built environment, our physical world, which is really everything around, the materials that we use to build, our infrastructure and our buildings, the supply chain of those, everything surrounding architecture, design, engineering, construction, everything that happens in buildings, around buildings, all the way to the grid itself and the relationship that buildings play with the grid. All those things can be tremendously better, more efficient, more sustainable, more digital, more affordable. And so that's what we're aiming for.
Absolutely. And you kind of touched upon this, and I think it spans beyond the built world with just startups in general. Adoption and scaling is kind of the name of the game. Do you have key enablers to success for adoption and scaling, especially as you're navigating being in the built world, which, as you said, is pretty antiquated and slow to adopt things? What do you see as success stories to be able to navigate the industry?
So my view has been relatively consistent. So when we started, there was no funds really doing what we do in Europe at scale, for some surprising reason, because, hey, Europe is actually a bigger real estate market. We have massive tailwinds on the regulatory side, great talents, but somehow there's often more ambition on the other side of the pond. And there was a few funds in the US doing that already in a pretty large scale. Those guys that adopted a model which was, let us have as many strategic LPs or folks who can be users, customers of those technologies. So we create this flywheel. And I think that's a brilliant idea. Our view was always, look, we are resource constrained as a fund. So is there really a lot more value in having 200 strategic LPs that we're bound to have relatively superficial relationship with because we're resource constrained, and we don't want our relationship to become more of a consultancy relationship? Or do we actually do not care to have as many? It's more about having fewer of those, but having the time and the resources to dig deep into understanding the organization, building strong relationships so that we can actually deliver adoption and transformation. And we took that view, which is, in real estate, it's more or less a followers industry. They all look and feel the same on the margin. And so I don't need 10 residential home builders in my LP base to understand how a home builder works. I need one, and I need the time to really understand them. And so that's really how we operated, as we've been able and lucky and fortunate to have some of those visionary real estate LPs in US, in Europe, in Asia, in the Middle East that really wanted to invest their time and their resources in this relationship with us. And they wanted like meaningful interactions. And so that has allowed us to really understand that and be pretty good at enabling this flywheel with our portfolio of companies. And if you look at it today, it hasn't been a straight line because it's hard to transform those large organizations or to help them transform. There's a lot of psychology, there's understanding the different stakeholders within those organizations. There is the incentives, the split incentives, what are the motives? And so we've spent a lot of time doing it, often at the beginning unsuccessfully, but that has allowed us to actually understand the roadblocks and iterate better and better, but to the point where now it's much easier. It's not easy, it's easier. And it still requires a lot of, involvement. But we definitely see those large organizations also acting differently, hiring the right sort of talent to be able to innovate and transform themselves. So that's probably been a great way for us to understand the industry, and so we're leveraging that. And today we're actually able to get our portfolio companies to be adopted by large organizations that are not our LPs, because we just know we have the network, we can reach out to them, and we don't need them to be an LP to be a customer. If that makes sense.
Absolutely. And do you think it's because, obviously you were Europe's first built world VC, and now you're the largest. Do you think that allows you to be different than VCs that are coming onto the scene focusing on the built world? Or do you think everyone is acting kind of similar and it's still very competitive?
So we were not the first one in Europe. I would say we just were the first ones to get to institutional scale with our first fund. There's a lot of great folks that have, been super thoughtful and were there many years before us. I think, in a way, perhaps too early, because I think this industry has been starting to move faster, in the last few years. So I think for us, we don't necessarily take pride that we might be the largest one or whatever. I think these are all like, I know the industry likes to put those tags on folks, the largest, the this, the that, we want to be the smartest and the most successful. And we don't care what size does to us. And it just takes a lot of hard work. We want to be consistent. And we've worked really hard the last 5 years to build a consistent relationship and reputation with all our stakeholders. So if you speak to our LPs, if you speak to our portfolio companies, if you speak to our co-investors, we want to be perceived in the same manner by everyone. We want to be consistent. We want to be genuine. And I think this helps create the momentum. You're reliable. You do what you said you would be doing. You don't oversell. You don't undersell. And in the end, people always come back and say, well, those guys are very consistent and they're doing everything they said they would. That is the best way to build strong relationship and strong reputation. And that's what we're working hard to do in a challenging market. The last years have been full of volatility, ups and downs, difficult conversations, but we're in a very good shape, and I think we have one of the best track records globally in the space.
Absolutely. And just staying on the topic of size, but reversing to the companies, does Noah focus, and maybe it started differently than it is today, does Noah focus on a particular stage within the companies, whether that be seed or growth? And has that changed over time? And what do you see going forward?
Sure. That's a great question. So we view ourselves as a specialist firm, and we want to be able to back the best businesses in our category and try to be as agnostic as possible about the stage. So our first checks can be seed, even sometimes pre-seed, if we have high conviction and that there's no other company to back this amazing team that fits really with our thesis. And our first check is good. So be seed A or B, first checks, and then we'll do follow-ons beyond that. I think that allows us to capture what we believe are the best companies in the early stage. Also, I would say these days, the stage naming or tagging is a bit all over the place. So you have a seed company that has millions of revenue raising, around, and then you have a Series B with zero revenue raising around. The lines are a bit blurred. But that's our strategy, and we invest both in Europe and in North America. So about 40% of our portfolio, up to 40% of our portfolio is in the US. And in our view I think it's important, if we do the work, if we have a thesis, to be able to back different similar company or in similar fields across the pond, because some of those markets are hyper local. Companies will just become leaders in the US without having to come to Europe. Not always, but sometimes. And I think in a world that looks like it's going to be less global than maybe it was by historical average, I think this ability to deploy our capital in high conviction verticals across multiple geographies, I think has paid off so far for us.
On that topic of being able to invest kind of internationally, what does the political headwinds do to different companies? Does it actually provide opportunities? And this is a kind of a hot topic within MIT's Center for Real Estate right now in terms of no one wants to lose the house to flooding, whether you call it ESG, resiliency, sustainability, whatever you call it. You still need insurance. You still need to be able to fund various things. Does this provide arbitrage opportunities for some of your companies to be, some of the only people focusing on how to, leverage these different climate changes, or is it going to be harder, for the next 3.5 years as, especially the U.S. focuses on, less climate resilience, sustainability, however you would like to frame it?
I have somewhat of a more controversial take on this, or let's call it more nuanced. I think there are two camps today. There's the camp, oh my God, the US is completely walking away from everything climate. This is the end of climate for the US for the next 3.5, probably for the next 8 years. And that's one camp. Our view is, for sure, it's undeniable that I think the climate agenda in itself is probably not going to be taking center stage, and there might be some rollback of previous initiatives, whether it's the IRA and things like that, and that's fine. I think that it's actually healthy, and let me explain why. And we've seen the same in Europe. There's a number of companies in the years of 2021, 2022, 2023, in the heydays, with infinite liquidity and free liquidity. There's a lot of companies that build themselves on the back of government incentives or rebates or whatever you want to call them. But those businesses were never going to be standing on their own feet and never going to be profitable because they were just artificially supported by free money and incentives and artificial incentives. And the problem when you do that is wisdom will tell you that incentives are never going to be there forever. And I can give you many examples in Europe where we are full steam ahead on climate. A lot of those incentives have been rolled back the last couple of years just because, it becomes political, there's budget constraints. So those things are meant to go away. And so I think in a world where more pragmatism around how to build a business in those space is required. And if you tie that up with our view that you can't just only sell something in the name of climate or the environment, it needs to have additional ROIs on top of it. Our view is that the best founders are going to build businesses that are not going to rely forever on those incentives or those policy making decisions. And they're going to build product that will sell purely in the name of financial incentives or financial ROI, and with the climate agenda hidden behind. And I think actually these are the businesses that we want to back, and these are the businesses that we've been backing over time. Everything else was probably not meant to be there or shouldn't have been there or shouldn't have been funded as much. And so I think in a way, in a counterintuitive way, where this could be a blessing in disguise that, yes, there is less willingness to support the climate agenda. And, I don't want to go into having an opinion on that. I think we'll need much longer session. But I will say this is also an administration that is quite pragmatic in the sense that they just want to maximize profit and financial incentives. And so I always refer to a good example, which is, Texas, which is obviously not necessarily the most climate conscious kind of state, is one where the adoption of solar is one of the highest, if not the highest. And it's because it's just cheaper. And if it's cheaper, let's use it, right? Not because it's greener. And so I think that gives me the hope that we're going to see the right tailwinds, and we just need entrepreneurs to accept this new reality and actually see it as an opportunity rather than something negative.
It's super interesting. And it's actually similar to, I'm from Massachusetts, and it's heat pumps are extremely efficient, but from an electricity usage standpoint, they're terrible in Massachusetts because it's so cold. But in Florida, they're amazing, and the adoption rate is through the roof. And so not that a lot of Floridians are thinking, I'm doing a lot of help for the environment. It's more of I'm saving a lot for my AC. So kind of similar to the Texas and the solar adoption. Kind of shifting to more of a broader but similar topic on, and again, it's similar to the adoption as well, of what kind of broader systematic changes do you see kind of the next couple of years around making a better built world? Do you think it's all driven by individual investment in making, individuals' lives better, or are there some things that actually need to change to help build this better built world that NOAA is kind of investing in?
I think a fundamental shift is really that decoupling from sometimes what I like to label the virtue signaling around climate versus the practicality of it, and really understand that, hey, yes, we obviously need to make the world better, greener, and all of the above, but it's just not possible to imagine that people will do it if it's not financially viable. It's just the way the world works. I mean, as much as we want to force it upon people and to do the right thing, you see it. People are all well-intentioned, and if suddenly they have to choose between paying their bills or being greener, the choice is pretty easy. They're not going to be greener. They're just going to do what's right for themselves. And I think this shift in narrative and in attitude, I think, is needed and is happening, which is, hey, we can be greener, but we need to be more practical and we need to be more financially viable. And if we can do that, if there's a solution that can do that, it should be adopted at a global scale and it should be a very, very successful company. So I think that's one thing. The second is, look, I think we need to also get the governments involved in a smarter way. I give you an example. When we had the energy crisis in Europe, in the early innings of the Ukrainian war, obviously utility bills skyrocketed 3, 4, 5x. And so there was a lot of political pressure in election time to just helicopter money to people to be able for them to just pay the increment in utilities. And actually, if you think about it, it's not a good decision because yes, there is higher prices, but the fundamental issue in Europe is that we have the oldest stock of residential housing, and those homes are not efficient. There's no thermal efficiency. They could have more solar. They could have heat pumps. All those things are what should be the solution to volatility in pricing. If you just helicopter money, people are just going to say, okay, well, whatever, I'm not going to do anything. The government's paying for the delta in my utility prices, and then there's no behavioral change. We need behavioral change. We need to incentivize people to go and retrofit so that the next time we have a spike, hopefully not, the next time we have a spike in our prices, well, our homes are going to be incredibly more efficient. And therefore, people are not going to feel the burden of this price instability as much as they did in the past. So that's what I mean by government being involved in a smarter way. I think we need more capital, but we need capital that's more pragmatic. In Europe, we have this issue that we have a lot of government funding, but it's not necessarily always put to best use. The incentives are usually not in the right places. So it ends up being, let's say, deployed in a way that's probably not the most efficient. So I think we need more consultation and collaboration between private and public. But I would say otherwise, I think if you double click on the industry, the built world, the real estate companies, the construction companies, I think everyone is realizing that there's now an opportunity to become more competitive through the use of technology. And I think if you want to build a firm in the real estate space for the next few decades, it's inevitable that you need to innovate, and you need to innovate hard and invest hard. And I think people have realized that. And I think that's the major change that we've seen in the last 3-4 years, that there's common realization that it is an imperative if you want to stay relevant.
I kind of got to bring in the $1 million question following that. What particular technologies do you find promising, disruptive, and whether that be, I mean, obviously everyone's talking AI, but also decarbonization and different, materials which are increasingly important. So, what do you find promising and disruptive in the world, and what are you looking at?
There's so many things that are exciting, which is a blessing and a curse in my job, which is we need to stay focused. But I will maybe refer to a couple of things. So everyone's talking about data centers. Everyone's talking about electrify everything, your car, your home. Well, none of that can happen because we have in Europe and in the US the oldest grid infrastructure. I think it's more than 50 years old or 60 years old. I don't have the stat top of my head, but something like that. And so, we've been investing, for example, a lot in grid efficiency through technology. So yes, we can all hope and wait for massive infrastructure budget to be unlocked by our respective governments, but we know those things take time. I think particularly these days, things seems to be a bit more complicated on decision making on the political front, and they require billions, if not trillions of dollars. So I think the demand for electricity in Europe is bound to triple in the next decade if we continue on that track of data centers, electrify everything. And so we've been investing in AI that's applied to the grid and enabling the grid to actually become smarter so that it can use its capacity in a dynamic way as opposed to a static way, which is to keep idle a lot of your capacity for 1 in 100-year event, which might never happen, and suddenly be a lot more smart in how the grid is unlocking its capacity to overnight release 20-30% capacity. So that's a space where we spend a lot of time. Another one is really smart building intelligence, bringing intelligence into those buildings. And we have a fantastic company that's effectively created the first fully autonomous building management system, allows to operate buildings fully autonomously, reduce energy consumption by 30 to 60%, carbon emission by the same amount. And I think it's a critical path for this idea of a smart, efficient, better built world is intelligence at a physical level, at a building level, at a grid level. So we've been spending a lot of time in that, which is AI for the physical world in a way. But that's something that we've been working on already for 5, 6, 7 years before AI was cool. And so that's the place where we like a lot. And then I think there's so much innovation that's going to be enabled by AI in material science. Today, there's so much innovation that can come in our industry in construction, but also in utility and in grid infrastructure by enabling the adoption of new materials that are more conducive, more efficient, cheaper. And so all those things are going to be happening a lot faster with the emergence of intelligence. And so we've been spending a lot of time with that with that theme. I think we'll be announcing a great investment in the space soon. And then there's everything around robotics. I think particularly in Europe we have a labor shortage. We have not enough qualified people. A lot of the qualified people are coming out of the workforce because of the aging population. So a lot of things will need to change from a productivity and from a skill set standpoint. We've been investing in labor upskilling. I think we'll do some interesting stuff in robotics as well. So all those things are pretty exciting and pretty groundbreaking. So that's what really gets us up in the morning, where I think the future holds a lot of promises that we feel are very close to being able to be delivered. I like to say the future is happening a lot faster than I've ever seen. Almost every day, every week, the world looks like a different place from a tech standpoint. So it's exciting. I know there's a lot of people who are scared of AI and stuff. I think there's just so many amazing applications that will come, particularly in our space, that it far outweighs some of the risks that are attached to it.
And does NOAA have kind of a 10, 20-year vision of what the world could look like? And are you part of kind of catalyzing that change, or is it kind of playing it day by day of saying, here's where the world is, here's what here are the technologies that are needed most today?
Look, we have to strike the right balance between not listening to the daily noise, and there's a lot of it these days. Particularly if you're connected, there's so much noise, so much attention seeking for all the different platforms that you can just fall into a trap, and I think it can be quite disruptive. At the same time, we should be thinking medium term. At the same time, thinking long term right now is very tough because everything is changing so fast. I genuinely believe the next 5 years will see more change than the last 20. And so I think it would be a bit presumptuous to think that we can see what the next 20 years hold. So I think we try to have a balanced view, which is let us back groundbreaking technology, which we believe are going to be transformational 5, 10, 12 years from now, and they're needed. At the same time, we can't afford to just wait. We need practical, readily available solutions today to get on the train, because I spoke before about the psychology of adoption in the built world. I think it's very risky to try and adopt something that is a massive leap forward, because the chances of failing are pretty big. And if you fail, then you give a lot of ammo to the naysayers in real estate to say, look, we thought, you can't change, it's too dangerous, it's too disruptive. So you need also to take the quick incremental wins. And I think the daily compounding of small change in a way can be much more powerful than large leaps forward every 2, 3, 4, 5, 10 years. And so we try to have in our portfolio stuff that takes care of this daily compounding. Sounds more boring, is maybe not as exciting on the outset, but actually is probably the foundation to a much greater future. And then also have in our portfolio the larger leaps forwards that will take more time to unfold and to be adopted.
That makes a lot of sense, and it's hard to predict anything, especially right now. But I've really enjoyed this conversation, and I want to finish with a question. It's not necessarily related, but it's actually stolen from a different podcast, How I Built This with Guy Raz. And you've had an illustrious career, and you've seen so many probably successful and your VC, so unsuccessful firms. And I'm curious, when you look at a startup and a successful one, do you see that there's more luck or hard work or a combination of both that creates a successful technology that truly disrupts an industry?
I would say the number one thing that I see and applies to the startup we back, and I think generally in life, is the ones which are the most resilient are the most successful one over time. Everyone needs luck. Often I joke that better lucky than smart, and I think it's true for many, many things. Obviously, most of the founders that we back are very bright minds, very smart, and so that's usually not the issue. The risk with very smart people is sometimes they lack the humility that's required to iterate whilst building a business. If you think you know it all, or if you know a lot, you might not be able to absorb and learn along the way, because you make plans and usually those plans don't happen. So you need that level of humility to allow you to navigate stuff that you haven't necessarily been planning for, or that go against your prediction for the future. But yeah, to answer your question, I think resilience. I would take resilience ahead of being smart or being lucky, for sure.
Absolutely. Well, Greg, thank you so much for your time.
Thank you for having me. It was a great conversation.
Greg is a founder and managing partner of Noah. Check them out and look at some of their amazing companies that they're investing in and changing the built world.
Thanks to our listeners for tuning into another edition of Meet the Visionaries podcast. And please remember to stay tuned for future episodes by subscribing to our podcast, or follow us on social media by visiting cre.mit.edu to learn more. Until next time, take care, listeners.